Most people think a 401k is just a retirement account. Wealthy people tend to treat it like a tax machine with a retirement account attached. A beginner asks, should I use the 401k, the Roth, or just get the match? A more advanced investor asks, which tax bucket am I filling? What income year am I managing? What fees am I paying? What assets belong here? And what exit doors will I have later? If you're brand new, here's the quick version. A 401k is an employer retirement plan. You contribute from your paycheck. Sometimes your employer adds money. Traditional contributions usually reduce taxable income now, then withdrawals are generally taxed later. Roth contributions do not usually reduce taxable income now, but qualified withdrawals can come out tax-free later. The money is invested inside the plan, using the menu and rules your employer provides. That is the beginner explanation. Now let us talk about how wealthy people actually use it. First, they design tax buckets. They do not argue about traditional versus Roth like it is a personality type. They treat it like tax planning. A wealthy household may have taxable brokerage money, traditional retirement money, Roth money, cash, real estate income, and sometimes business income. Traditional 401k money can lower taxes now, but withdrawals may create taxable income later. Roth money may cost more in taxes today, but can create flexibility later. Instead of hunting for one perfect bucket, they ask, which bucket gives me more flexibility later? If someone is in a very high income year, traditional contributions may be useful. If someone is in a lower income year, Roth contributions may be attractive. But tax laws and life situations change, so this is not personal advice. The advanced habit is not predicting the future perfectly. It is building options. Second, wealthy people understand the contribution layers. Beginners usually ask, how much do I need to contribute to get the match? Advanced investors look at the employee contribution limit, employer contributions, catch-up rules when eligible, and whether the plan allows after-tax contributions. After-tax contributions are not the same as Roth contributions. The earnings may still be taxable if handled incorrectly. In some plans, after-tax money can be converted into Roth money. This is often called the mega backdoor Roth. It is not available in every plan. The plan must allow the right features, limits still apply, taxes can be triggered, and paperwork matters. But higher earners pay attention because certain workplace plans may create an additional Roth pathway. The beginner sees one account. The advanced investor sees doors inside the account. Third, they treat the match and vesting schedule as compensation. A match is not just a bonus. It is part of your pay package. But the advanced question is not only, how much is the match? It is, when do I own it that is vesting? If employer contributions vest immediately, they are yours right away. If they vest over time, leaving the company early may mean forfeiting part of the employer money. So when wealthy employees compare jobs, they look beyond salary. A better match, faster vesting, lower fees, and stronger investments can quietly improve total compensation. 401k details are quiet compensation. Fourth, they do not accept the default investment blindly. Many plans place new contributions into a target date fund. That can be reasonable. The problem is not knowing what you own. Wealthy investors check the expense ratio, the asset mix, and whether the money is actually invested. Cash can have a purpose, but accidental cash in a retirement account is usually not a strategy. It is a leak. If you want a practical reason to subscribe, that is what this channel is for. Learning how to read the financial machinery calmly, without hype, shame, or panic. Fifth, wealthy people think about asset location. Asset allocation is what you own. Asset location is where you own it. A person with only one account may not need to think much about this. But as balances grow, location can matter. A traditional 401k shelters growth from current tax, but withdrawals are generally taxed as ordinary income. A Roth account may create tax-free qualified withdrawals. A taxable account may offer different capital gain, dividend, and tax loss harvesting treatment. So an advanced investor may decide that some assets fit better in tax-deferred accounts, some fit better in Roth accounts, and some fit better in taxable accounts. This does not mean everyone needs a complicated portfolio. Simplicity is often a strength. Sixth, they use Roth conversions with timing, not emotion. A Roth conversion moves pre-tax money into Roth status and usually creates taxable income in the year of conversion. The point is timing. Wealthy people look for lower income windows, a year between jobs, early retirement before required minimum distributions begin, or a year with unusual deductions. During those windows, they may convert some traditional money to Roth on purpose instead of waiting for forced income later. But conversions can affect taxes, Medicare premiums, estimated payments, and cash flow. Once done, they are generally not something to casually undo. That is why this is planning, not a trend. Seventh, they understand exit doors before they need them. A 401k is not a bank account. That is part of its strength. But wealthy people still learn the withdrawal rules. One example is the rule of 55. In general, if you leave your job in or after the year you turn 55, you may be able to take penalty-free withdrawals from that employer's 401k, though income taxes may still apply. Plan rules matter, so verify before relying on it. Another issue is 401k loans. A loan may look harmless because you are borrowing from yourself. But if you leave the job, repayment can become urgent. If mishandled, it may become a taxable distribution and possibly trigger penalties. Wealthy people usually do not use the 401k as their emergency fund. They build liquidity outside the plan. They use restrictions as protection and liquidity as freedom. Eighth, they handle old 401ks on purpose. Many people collect old plans like forgotten boxes in a garage. That can create forgotten logins, outdated beneficiaries, duplicate funds, and higher fees. A wealthy person asks, should this stay, roll into the new employer plan, roll into an IRA, or be handled another way? There is no universal answer. Keeping an old plan may make sense if fees are low or options are strong. Rolling into a new plan may simplify life and may help preserve certain backdoor Roth IRA planning options. Rolling into an IRA may expand choice, but it can change fees, protections, loan access, and tax strategy. The advanced move is not automatically rolling everything over. The advanced move is knowing why you chose the destination. Ninth, they check for special plan features. Some plans offer a brokerage window, sometimes called a self-directed brokerage option. This may give access to more funds beyond the core menu. That can help a knowledgeable investor lower costs or refine a portfolio, but it can also create complexity and concentration risk. More options are not automatically better. Useful options are better. Company stock is another special case. If your 401k holds employer stock, there may be rules around net unrealized appreciation, often called NUA. In some cases, company stock distributed from a plan can receive different tax treatment. This is highly specific. The simple lesson is, if company stock is inside the plan, do not roll it over blindly before checking whether special tax treatment might apply. 10th, they plan for required minimum distributions and beneficiaries. A large traditional 401k can become a future tax problem if there is no exit strategy. Required minimum distributions, or RMDs, can force money out later in life whether you need it or not. For high savers, that can create a tax squeeze. RMDs, Social Security, investment income, and possible Medicare premium effects all landing together. That does not mean traditional contributions were bad. It means the plan needs an exit strategy. Beneficiaries matter too. Retirement accounts pass by beneficiary designation, not just by what a will says. If the form is outdated, the wrong person may inherit the account. Again, not a reason to panic. A reason to plan. And finally, wealthy people let the 401k be boring. They do not need it to be exciting. They do not need it to be the entire wealth plan. They use it as a foundation: automatic contributions, tax advantages, employer money when available, and disciplined investing. Then they build flexibility outside of it: cash reserves, taxable investments, insurance where appropriate, estate documents, career capital. A 401k is powerful, but it is not a complete financial life. It is one engine in the machine. So here's the advanced checklist. Do you know which tax buckets you are building? Do you know whether traditional or Roth fits this year, not just your opinion? Do you know whether your plan allows after-tax contributions or in-plan conversions? Do you know your match, vesting schedule, fees, and actual investments? Do you know how old plans, withdrawal rules, RMDs, and beneficiaries fit into the larger picture? That is how wealthy people think about a 401k. Not as a mysterious box. Not as a one-size-fits-all answer. Not as something to ignore until age 65. They use it deliberately. They use it patiently. And they use it as part of a larger plan. The beginner question is, should I contribute? The wealthy question is, what job is this account doing in my financial system? When you can answer that, the 401k stops being just a deduction from your paycheck. It becomes a tool. And tools are how wealth gets built, protected, and eventually transferred. If this helped you understand your 401k more clearly, please consider subscribing. It costs nothing, but it means a lot to me, and it helps this channel keep making calm money lessons that people can actually use. Keep learning, keep asking better questions, and keep building your plan one smart decision at a time. Thank you for watching, and I'll see you in the next video.